Hello friends. Welcome back to Finance Central. In today's video we are going to talk about dividends. So whenever we talk about investing in stock market, we can earn money in two ways. The first is due to the increase in stock prices. For example, if we have purchased a stock at 100 rupees, and if it reaches 150 rupees in a year, it means we have earned a profit of 50 rupees. Now, the second source of earning a regular income via the stock market is called dividends. But before we get to understanding dividends, and things to keep in mind, a like to the video would be motivating. And a sub to the channel would feel generous. So, let us understand. What exactly are dividends? Whenever a company earns profits, the company can utilize these profits in two different ways. First, is to reinvest the profits back into the business, for its future expansion plans and growth, or if they need money to acquire another company, or any other reason which may require heavy investments. In such a case, the company retains the profits with them. The second way to utilize the profits is by paying dividends to the shareholders. If the company wants, they can distribute a part of their profits as dividends to their shareholders. And generally, dividends are paid from the profits after clearing all expenses. That also means that companies that are stable would have made a considerable amount of profits to give dividends. Loss-making companies usually don't give dividends. And companies that are in the growth phase usually reinvest their profits back into their business for expansion, as we understood earlier. Now that we understand what dividends are, let us understand the different types of dividends. There are two types of dividends a company announces, based on the time frequency. These are interim dividends and final dividends. There is a very small difference between the two. The name final dividend is self-explanatory. Final dividend is the dividend that is given at the end of the financial year. This happens when it is declared in the annual general meeting that all equity stakeholders will be given dividends. This means that when the final accounting statements of a company are ready, and they understand the year-on-year profit, that is when the final dividends are announced. For example, if you have 500 shares of Reliance Industries, and if the company announces 10 rupees per share as dividend, then in such a case, the total dividend value is 5,000 rupees. Similarly, if the company announces 15 rupees as dividend in the next year, the total dividend value will be 7,500 rupees. Now in case of the interim dividend, the company can declare this at any point through the year. Unlike the final dividend, the company doesn't have to wait for the end of the year to declare it. If the company, in any particular quarter makes substantial profits, it is very possible that the company may declare a dividend in the middle of the year. This is what we call interim dividend, and no AGM is required in such cases. Usually they are declared after the quarter, or the semi-quarter results. Now let us understand the four important dates associated with dividends, which every retail investor investing in stock market must know. So that you understand if you are eligible for the dividend or not. The four important dates related to dividends are declaration or announcement date, ex-dividend date, record date, and payment date. Declaration date is the date on which the board of directors approve and announce the dividends. On this date, they also declare the issue size, record date, and payment date as well. Now the ex-dividend date is the date that occurs 2 days prior to the record date. Retail investors or shareholders that buy shares post the ex-dividend date are not eligible for the dividends. This means if you wish to be eligible for the dividends, you need to purchase the shares before the ex-dividend date. For example, if the record dividend date of a company is 25th May, then the ex-dividend date becomes 23rd May. Now coming to the record date. Record date is the day when the company announces who is eligible for the dividend, and who is not. Those names who are eligible on the record date get the dividend by the company. Remember, investors buying the shares on or after the record date are not eligible for dividends. Lastly, we have the payment date. On this date, the company distributes the dividends to all eligible shareholders. In the case of interim dividends, the payment date is 30 days after the announcement date. And in case of final dividends, the payment date is 30 days after the AGM. To quickly sum this up, take a look at the table. For example, if ABC Limited announces on 20th of February 2021 that they will pay dividends, and if they set the record date to 15th March, then the ex-dividend date is 13th March. Now let us understand the most important part of dividends. The impact of dividends on the company's financial health. Generally, when a company pays dividends, as retail investors we are extremely happy that there is some small but regular income coming via dividends. But, is it the right decision for companies to pay dividends? Let us understand this. Paying dividends does affect the company's equity. Like we understood at the beginning of the video, that dividends are nothing but a part of the profits, which a company distributes to its shareholders. A company can very easily not give the dividends and retain the earnings with them, so that the company can use it for its growth and expansion. But giving dividends would also imply that the company is reducing its reserves and surplus, decreasing the equity of the company. And this is also reflected as an outflow in the cash flow statement. Paying dividends doesn't affect the value of the company, but it definitely affects its share price. As soon as the company declares dividends, the share price increases. This is because post the announcement date, a lot of investors that are keen on dividend-paying stocks invest in them. And this results in an increase in the share price. On the flip side, a sharp fall or decline in the stock price is seen when the company declares the eligibility of the dividends on the record date, stating who gets the dividends and who doesn't. This happens because those investors who invested just for the dividends tend to sell the stock. This is just a possible scenario and not a rule of thumb. It is not necessary that this happens with every company. This is just a perspective to keep in mind. Now it may cross your minds that paying dividends can be risky for the company. So why does the company still pay dividends? What are the reasons? The first and foremost reason is to build the trust with their shareholders, so that the shareholders stay invested for a long time, and because they get regular dividends, there is a possibility they will continue to further invest. The second reason is to honor the sentiments of the shareholders, to make them feel privileged for investing in the company. Another reason why a company pays dividends is because it is believed that a company that pays dividends is probably doing very well, growing well and making substantial profits. It encourages and reflects the company's financial health. And therefore, the company attracts a lot of investors who look for regular income via dividends. Another advantage of investing in dividend stocks is also because the dividend income, to a certain extent, is tax-free. So hope you enjoyed this video and the concept of dividends. Do like the video and also share with your friends and families. And don't forget to subscribe to the channel and hit the bell notification for more such interesting videos. Goodbye.